Good morning. Welcome to Stock Market Today for Friday, March 13th, 2020. I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter. I'm at Dan Russo _CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today where you can sign up for a free email to follow along with this show. Where we get a lot of the content for this show from that email. This will give you daily stock ideas to consider that hits your inbox every trading day before the market opens. So we're going to dive right in. It's been a long week, and it's really been a historic month for the market. But diving into the S&P 500 large cap index, the major averages fell more than 9% on the day yesterday. We sliced through this 50% retracement level like it wasn't even there, and we actually tested the 61.8% retracement overnight. Stocks are in a bear market, right? Across the board, averages are down more than 20% from their highs. Additionally, we are well below the moving averages here, right? If we take a look at the 50-day moving average, it's still up here at 32.08, and the 200-day is at 30.49, beginning to curl down, but we are well below the moving averages. The RSI did flash a slight positive divergence, so I guess a starting point, if you will. Remember, it was this divergence up here that started to say, hey, that's a warning sign. So potentially this divergence is a warning that selling may be abating. We're not seeing enough evidence just yet, but we are on the lookout. Chaikin money flow is neutral, been hovering up and down for the past few days, above and below the zero line. So what we think the best course of action is listen, we're likely to see near-term rallies here. And we want to see signs that selling pressure is abating. We are now in a bear market. Don't know if this is the end of buy the dip. It certainly feels like it, but we want to give the market more time to stabilize and kind of prove itself out. The burden of proof is now on the bulls, is a good way to kind of think about what's going on in the marketplace right now, right? I think that investors are going to treat rallies with skepticism. We'd rather wait for signs of stabilization before becoming overly aggressive on the long side of portfolios. Turning now to our market in a minute. What are we writing about in the note today? Well, it's Friday. We look at key themes and relationships as they relate to risk aversion. And what I will say is they are now at extreme levels, and I'll talk about what that means a little bit, right? We already touched on the fact that the major averages are firmly in bear market territory after 9% declines. We're still looking for signs that selling pressure is abating, right? Continue to tune in every day here where we look for signs that the sell-off is running out of steam. Growth outperforms in a slowing growth world. We've talked about that for a while now, and futures do point to a higher open today. As a matter of fact, last I checked, they were trading limit up 5%, thereby being halted until the open, or they cannot go any higher until the open. Turning now to the major indices from a power bar perspective, and folks, in the over 2 years that I've been doing this at Chaikin Analytics, I don't think I've seen numbers this low in terms of bullish names. The Dow lost 10% yesterday, 0 bulls to 6 bears. The S&P 500 was down 9.5%, 1 bull to 129 bears in that group. The NASDAQ, call it a slight outperformer, right? Outperformed by 40 basis points, 2 bulls to 24 bears there. Small cap stocks continue to underperform the broader market. Small caps down 11.26% on the day yesterday. 3 bulls to 507 bears in the IWM. Bonds uptick slightly. According to the Chaikin Power Bar, small cap stocks and large cap stocks have become strongly bearish, and the major indexes are strongly bearish. That's based on these Power Bar ratios. Turning now to our stock of the day, and really for no other reason, we know it's auto-generated, but realistically, I think this is the lone stock in the S&P 500 that has a bullish rating. It's Regeneron Pharmaceuticals, very bullish stock. Closed at 431.89 yesterday, down 7.06%. Chaikin Power Gauge rating is very bullish due to very strong price volume activity, very positive expert activity, attractive financial metrics, and strong earnings performance. So those 20 factors kick out a very bullish Power Gauge rating for a stock that's still in a strong trend, right? You've heard me say it. Not many stocks are above their rising long-term trend lines, right? The industry group is weak, but that's largely a function of Power Bar ratios, which are weak across the board. Regeneron has held in, and what I see is a breakout through this 420 level, and now a pullback that has come to retest that breakout level. All right, we have a very bullish stock outperforming the market with bullish money flow. That's the type of name we want to consider. The question is, do we want to consider it now, right? And I'd say the overbought, oversold indicator is middle of the range. Obviously, you've heard me talk. We want to give the market time to stabilize, right? There are going to be some good names out there. There are going to be names out there that begin to move higher ahead of the market, and those are the names that we would try to focus on. But remember, stocks that look like this, stocks that have relative strength that look like this, if you're reading our notes and if you're using Chaikin Analytics, or if you've taken that 14-day trial, it's this relative strength that we're looking for. If you're using stockcharts.com, you can look at relative strength as a ratio, or you can use the scooters, but find the names that have held up as the market has sold off, because these are your likely leaders coming out of the market when coming out of the downturn. Should we begin to see signs of a stabilization? Our sector tracker, movement of the major sectors over the last 5 days, and really, this is an exercise in what's been less bad, right? There's no two ways about it. I'm not going to pull any punches here. On an absolute basis, there's been nowhere to hide, right? There's essentially been nowhere to hide in the market. I mean, we looked at the chart yesterday. Even treasuries are coming under pressure now, right? Corporate credit, high-grade corporate credit is under extreme pressure now. There's nowhere to hide in the market from an absolute basis. So what does that mean? That means look for the relative strength. Look for the areas of the market that have held up the best as the market has turned lower. And then when we begin to see a base building process, we can start to turn to those areas to look for ideas, right? Healthcare, top of the list. Staples, defensive in nature. Comms has a little bit of everything, both offense and defense. Tech, in the top 4, but still down 17%, and REITs are highly defensive. I mean, look, even the utilities are not at the top of the list anymore. They're selling whatever they can at this point. Discretionary, down 17%. Industrials, materials, fins, and energy at the bottom of the list. Folks, I think I've said all there is to say about energy at this point. There may come a time when it makes sense to start looking at energy stocks. We're not there yet. All right, we're going to stick to our process. And, I had a lot of questions, or, how much lower can energy go? Don't you think it's time to buy energy? Look at the yields on some of these stocks, right? I've had names pitched to me. I don't care, folks. Underperforming and bearish is not where I'm looking for ideas. Financials, obviously, lower rates have been a headwind there. We've talked about that for some time. Materials and industrial levered to global growth, which is clearly slowing down. Our industry in focus now, NASDAQ, NYSE Tech Services, which over the past 6 months has outperformed, right? This is one of those outperforming areas in the market. It's outperformed the S&P 500 by 10.26%. In this case, that means less bad. Power bar ratio is very weak, 5 bears to 1 bull, but this is the top group from a power bar perspective for the 21 industry groups that we look at. This is the top group, having moved up 3 slots over the past week. Now, bearish names, we want to avoid them. Shopify, Tesla, Qualcomm, right? All very bearish or bearish based on the Chaikin Power Gauge ratings. But what we're going to find is when the market stabilizes and this begins to move higher, more names will creep out of neutral and into bullish, and we'll begin to look for opportunities there. Taking a look at the fund now, XITK is the ETF that tracks this group. Neutral Chaikin Power Gauge ETF rating. The trend is weak, below a declining long-term trend line. You can see the precipitous waterfall decline that we've seen here. The fund is oversold. Bullish money flow is encouraging. Like I said, this has just been one of the areas that's been less bad, right? There's no two ways about it, right? As I said earlier, it's an exercise in what has been less bad, okay? What I strongly urge is stay engaged with the market. I think it's easy in times like this to turn it off and just completely disengage. I don't think that's the right strategy. Stay engaged with the market. Look for signs of less intense selling pressure. Continue to build watch lists. Continue to focus on the areas of the market that have held up the best. Now, taking a look at what's trending now, yesterday's S&P 500 movers and shakers are gainer and losers, and I say gainer singular because there was only one in the S&P 500 yesterday, and it was actually an energy stock, but it's a bit of a special situation. Occidental Petroleum, OXY, has a very bearish rating at Chaikin Analytics. However, activist and legendary, quite frankly, investor Carl Icahn, there were rumors that he was increasing his stake in the company. He did, in fact, file a 13D to the effect that he was increasing his stake. He's trying to shake up the board and management. So it's a bit of a special situation at this point. The rest of the energy patch just doesn't look great to me, as I've touched on numerous times. On the loser side of the board, the cruise lines continue to be under pressure, right? Coronavirus fears. Folks, nobody's taking a cruise. Norwegian Cruise Line down 35.8%. Royal Caribbean, RCL, down nearly 32%. Carnival Cruise Line, down 31%, as Moody's downgraded their rating on Carnival. As well, they are canceling their Princess Cruises for the time being. That stock under massive pressure. VTR, this is a REIT, and they operate senior housing facilities. And right, the coronavirus is more impactful to seniors based on everything that we know and what we're reading. So REITs that are exposed to senior housing have come under massive pressure. VTR down nearly 28% yesterday. And MPC exploring an asset sale. This is one of those energy names. Down nearly 27% on the day yesterday. So let's just dive into it. I wanted to take a look back and see just how historic this move has been, right? We talked yesterday about how it was the fastest the market ever went from an all-time high into a bear market. But I wanted to look back and say, what have the last 4 weeks really looked like on a historic basis? And I mean, I went back 30 years to 1980. This is a weekly chart of the S&P 500. The good news for really long-term investors is that we are still in an uptrend. But obviously, we're all concerned with what's happening in the near term. So I just wanted to kind of put it into perspective and touch on how historic this has been. What I have here at the bottom of the chart is the 4-week rate of change for the S&P 500. So what has the S&P done in percentage terms over the past 4 weeks? We know it's been down, but what does that mean historically? We're down nearly 27% over the past 4 weeks. I mean, unprecedented move. Really, how unprecedented, right? It rivals the aftermath of Lehman Brothers in October 2008, right, at the start of the global financial crisis. And it rivals the stock market crash of 1987. You can see it back here, a drop into the mid-20s over a 4-week period. That is how historic the last month of trading has been here in the U.S. equity markets. And what that's done is it's caused risk aversion to become extremely extended to the downside. This is a chart you've seen numerous times from me. It's high yield versus investment grade. High yield corporate bond ETF relative to the iShares 7 to 10 year Treasury bond ETF. And it has completely fallen out of that, right? We've seen that. We've talked about that. I can draw the trend line here, but at this point, you should be able to see how precipitous this breakdown has been. Confirmed by momentum as it's extremely oversold and coinciding with a decline, really a precipitous decline in 10-year yields, massive flight to safety up until the past couple of days. But how extended are we to the downside? The 200-day Z-score. So how extended are we from the 200-day moving average? And the 200-day Z-score stands at negative 5.73. That's almost 6 standard deviations below the 200-day moving average. Folks, that is the definition of extended. And if we look at some of the other risk metrics, I touch on them in my note today, a lot of them are more than 4 standard deviations below their 200-day moving average. So that just goes to show you the extreme level of fear and risk aversion in the marketplace. Growth versus value, we've talked about it a lot. You can just see it here, massive outperformance by growth over value. In a slowing growth environment, investors will tend to favor growth over value, right? If growth is scarce, investors are likely going to gravitate towards what is actually growing. You can see the breakout confirmed by momentum also coincides with the Qs outperforming the SPY. Now, outperformance again in this regard, again, just means less bad. So happy Friday, everyone. That's going to wrap us up for today. Head over to chaikinanalytics.com/test drive. Take a 14-day trial. You get my note for 2 weeks. Mark Chaikin's note on the weekends where we've touched on everything that's going on in the marketplace currently. I hope you stay engaged with the markets. I hope that you have a great weekend. I will be back here with you on Monday for every twist and turn in this volatile market. Have a great weekend, everyone.